Right, good morning everybody and welcome to Prudential's first ever webinar. I'm Hamilton van Breda, Head of Retail Sales here at Prudential, and with me I've got Chris Wood. He's a Senior Equity Portfolio Manager, and this morning he's going to give us some insight into how we've been managing our equity portfolios through this pandemic, taking advantage of some of these exceptional opportunities and also trying to avoid some of the heightened risk. In terms of housekeeping, after the session, we will have a question and answer session. So you'll notice a Q&A button on your Zoom facility. So as and when you're wanting to ask a question, please send this through to us sooner rather than later. We will no doubt have a couple of questions, and we'll try and answer some of the questions at the end. Those that we don't answer, we will certainly come back to you and send the replies to you. In terms of CPD points, this webinar will attract CPD points. We're just waiting for the Financial Planning Institute to give us a report on that in terms of how many points will be available, but we will obviously let you know in due regard. We will also be sending you a copy of the presentation. So please enjoy the next hour with us, and without further ado, I'm going to hand over to Chris for his presentation. Thank you very much.
Thanks, Hamilton, and thanks to everyone for tuning in to this first ever Prudential webinar. Today, my presentation is going to focus on the Prudential Equity Fund, and these are, as Hamilton introduced, extraordinary times. We believe that there are exceptional opportunities available to us today, and I'm going to try and leave you with a clear message of why that is, and having a look at the idea that today is we're being presented with the opportunity to invest in South African equities. I will be using 4 recent examples of opportunities that have been implemented in the fund. To kick off, I came across this quote in an article I was reading last month, and I think it's very apt to this message. There is no question that in a month like March, where our market and those of global markets have fallen, losing more than 1/3 of its value, it's counterintuitive, the quote, but what I'd like to leave you with is that these events, these crises, create opportunities, and that the potential to generate exceptional returns from this point forward hopefully will make up for the short-term pain and negative impact of having experienced a down market. I think it's important to just reflect or refresh everyone. You're all familiar with Prudential, but there are 3 core principles that underpin our philosophy. First and foremost, we are valuation based. By that, I'm referring to the fact that in making a decision to buy or sell a stock, that decision is based on an assessment of what we believe the asset is worth, and where possible, we are looking, to buy assets trading at deep discounts to that assessed fair value. Secondly, it's in our name, but we are prudent investors. By this, I mean we seek to construct a portfolio that is diversified and that takes measured positions. We recognize that sometimes our view on the world may be wrong, and that we give equal consideration both to the stocks that we put into the portfolio as well as those that we leave out, and implement measured size of position relative to the expected return. And lastly, and I think this is probably the most important message for today, is that it's very easy to get caught up in all the negative noise and the news that we hear on a daily basis, but that we are seeking, we're taking a longer term view, playing the long game, trying to identify those companies that we think will be here in the future and that have sustainable businesses, and to take advantage of the discount at which they potentially trade today. So where do we find ourselves today? This graphic on screen is taken from last week's Financial Times. It represents by country the fact that, in this global pandemic caused by the coronavirus, there's clear evidence of a increasing loss of life, so excess deaths relative to sort of a typical average. But I hate to say this, but this is not what the market is concerned about. It's not, the number of people that have died to date is approaching 250,000. But what the market is worried about are the consequences of the political decisions to enter into, a lockdown in order to try and stem the transmission of the virus. What we can see on the chart on the right is US employment statistics. And in a very short space of time, so in the course of the last 8 weeks, the US job market has lost 21 million jobs. To put that in perspective, it's all of the jobs that were created in the last decade, so since the financial crisis. It remains to be seen whether these jobs are permanently lost. We don't think so. As and when business restarts and the economy restarts, hopefully there'll be a recovery. But the heading of the title, Corona Coma, is a term coined by US economist Paul Krugman, and in his article in the New York Times, he sort of described the fact that this is not a conventional recession. This was not a financial crisis caused by a demand slowdown that through as we would typically expect. Instead, this is the equivalent of a medically induced coma. Policy decisions that effectively have stalled the global economy as countries around the world have embarked on these lockdowns. So every day we get these daily updates of who's infected and all the bad news, and so it's very easy to sort of challenge my optimistic outlook. But I think what's important is we have to focus on what's in the price, what is the market discounting, and whether or not that presents an opportunity. So in this, this valuation series, it's a very long series. It represents 40 years of data on the South African market. This is the price to book of the index, the South African equity market. And in the month of March, we saw that as a result of the price falling more than 35%, this valuation multiple is the lowest in 40 years. So, we see this as being a very interesting barometer of the value opportunity presented to you as an investor. And that even though we've had a sort of a recovery in April, we are still trading at or below levels seen in previous crises. So the global financial crisis of 2008, the early 2000s, and going all the way back to the Rubicon event in the early 80s. If one compares this to the rest of the world, here we have the price to book of the world market. It too has fallen, but unlike South Africa, the price to book multiple simply pulled back to its median of around 2 times, and didn't pull back nearly to the same extent, and is not as low as it was in the global financial crisis. We think that this presents an interesting opportunity, and that there's a strong case to be made that there are potentially better investment opportunities in South Africa today than are available to you as an offshore investor. If we take that 40-year history and have a look at had you bought at different points in time at a given price to book multiple, what the subsequent 5-year returns were, we can see that there's a clear relationship. So as the old adage goes, price is what you pay, value is what you get, and so the higher the price to book, the lower the prospective or subsequent 5-year returns delivered to you are, whereas the red vertical line represents where that price to book multiple is on the JSE as at the end of April. Interestingly, the blue dot to the left of the red line was in fact the month of March. What one can see is that while there's a range, the vertical line is the full range of potential prospective returns. Given past history, you are being given what we think high odds on delivering above average returns given the low multiple on offer to own SA equities today. As an alternative measure of value, to look at what valuation signal is being presented by the market today, what we've done here is we've ranked all the companies making up the all-share index by their dividend yield, and we've taken the top half of the high-yielding stocks, or so-called value stocks. We've compared the median of the value basket to the median stock, or the 25th percentile stock in the bottom half, so the non-value. And this red series represents that differential in yield. So in the month of March, at the extreme low point of the market, you could see that you were being offered almost 8% additional yield to own that out of favor value basket or value stock over and above the yield at which the non-value traded it. Now, there's certainly views in the market that these dividends may be postponed or suspended. The point here is that while that may be the case for the coming year, we don't think that dividends will be indefinitely postponed, lost, and that at a point in the future, this value uplift of yield can be realized. So moving on to the stocks, I'm going to give 4 examples today of opportunities that have been presented to us. The first is Sessile. This is a company that has been in the portfolio, and over the course of the last 12 months has been a significant detractor to performance. In hindsight, it's a stock that we potentially, we wish we didn't own. What I'm showing in the chart here in the red columns is the total debt, and overlaid is the dollar per barrel Brent oil price. Sessile derives its profitability and revenues are directly linked to that oil price, and the market is clearly concerned about the health or lack thereof of Sessile's balance sheet, given this very large debt in excess of 160 billion rand, in an environment where this is a perfect example of a commodity that is caught up has been impacted by the coronavirus. So a lockdown has resulted in people not driving. Planes are grounded, and therefore oil reflects a demand shock. We certainly did not anticipate the extent to which oil has fallen from $60 a barrel to as low as $20 last month. So today I'm going to talk about that debt and the balance sheet of Sessile. Where has this debt come from? This is an image of the Lake Charles cracker project in Louisiana, the United States of America. This is a mega project that Sessile has embarked on 4 years ago. Initial estimates were that it was going to cost between $8 and $9 billion to construct. As it turns out, and what has been a huge disappointment for Sessile shareholders, is the extent of the cost overruns, costing more than $12.5 billion. And this largely is the debt that we see today. So this chart is particularly busy, and I'm going to spend some time just unpacking it for you. What we've tried to show here is an assessment of the carrying value as per Sessile's financial reports So on the above the x-axis is the net is the assets by division, and below the axis is the liabilities. The blue solid line that runs over the, through the middle of the stack represents the net assets of Sessile. That is the sum of the total assets less the liabilities. And what one can observe here is that the net assets, as they stand today, reflect the fact that there is very little, if any, value contribution from that cracker project. So the Lake Charles cracker is in the mustard color at the top of the stack. But what we can see is that over the 4 years, that project was funded through debt in the bright red at the bottom of the chart. And the extent of the debt today, as a result of the weakening rand, most of this debt is dollar denominated, is around 200 billion, including other liabilities. And that negative value is almost a matching value for that Lake Charles cracker. What we've done in that last April 20 column is we've assumed that the cracker is actually only worth $9 billion, what it was intended to cost to build. And the reason there's no difference to the last reported December data point is that the currency has effectively depreciated by almost a third, and matches the sort of lowering or reduction in that cost from the 12.5. What one can see in the solid dark line is the market capitalization of Sessile. And here we can observe that in relation to the blue line, Sessile is trading at a very deep discount to its book value or its net assets. The pink line is the market cap plus the debt. So that's what is referred to as the enterprise value of the business. And so what the market is clearly concerned about is how does Sessile repay this huge debt burden in an environment of low oil and constrained profit generation. What the management have undertaken is that they are going to, before turning to shareholders to fund, sort of recapitalization of the business, they would ideally like to look at selling a portion of or a significant stake in the cracker to a strategic investor and use those proceeds to pay down debt. But my point today is not to discuss Sessile's equity, but it's to focus on the red. It's the opportunity presented to us by the market to actually take a position in Sessile's debt. So in these charts, what I'm showing you, Sessile has 3 dollar-denominated bonds, corporate bonds, each with a different maturity, 2022, 2024, and 2028. Maturity profile. In the event of this crisis, the fall in the low oil price prompted a downgrade to this debt that we believe contributed to the forced selling. And in the top chart, we can see that the bonds went from having traded at face value of 100, and in the course of March, bottomed at around 40 cents in the dollar. The chart on the very bottom is just the 2024 bond. It's the yield to maturity, and we can see that initially those bonds were trading, as I say, at face value, yielding their coupon rate of just less than 6%, and that as a result of the price fall, those yields rose to around 30%. As one can see, the price of the bond has since rallied. In the Prudential Equity Fund, I can imagine that there's some skepticism as to why we're looking at the bond market in an equity fund. But the point I'm trying to make here is that there was an opportunity to buy these bonds trading at a deep discount to their face value, and that they offered equity-like returns. We bought 2% of the fund. We used the offshore allowance to acquire a position in the 2024 bonds on the basis that Sessile is a strategic asset, will not be allowed to fail, and that even in the event of a recapitalization, you as a bondholder will be made whole. The other way to think about it is if I'm buying the debt at half of its face value, the 200 billion that was on the previous chart, I'm investing with the debt at 100 billion, and given that Sessile has net assets of 200 billion rand, we're fairly confident that even if it were to go into liquidation, that one would get a recovery on that initial purchase. The next company I'm going to talk to is Bidcorp. Here I'm showing the share price, and year to date to the trough in March, the share was down 44%. Bidcorp is a stock to which the equity fund did not have a position prior to March, but as a result of the significant price fall, it prompted us to have a closer look, and we have subsequently purchased and closed what was an underweight position in the portfolio. For those who aren't familiar, Bidcorp is a food service business. This is an image of one of their trucks in the UK, in London. It is, as some would, can imagine, somewhat in the eye of the storm, in the sense that most of the customers that bid food services are in the hospitality industry, restaurants, hotels, as well as corporate canteens and the like. And obviously, with the advent of the lockdown, the trading activity of these businesses or these customers has been put on hold, which is what the market is most concerned about. What we like about Bidcorp is that it is a geographically diversified business. So it's a global business. It's therefore a beneficiary of rand weakness. It earns a larger share of profits from outside of South Africa. It does have a South African business that in this chart is captured in the top of the stack in the emerging market division. What this chart shows is the operating profit generated from each region. And what we can observe is that this business over time has delivered steady compound growth in profits, and that as we look into 2020 and 2021, those are forecasts, there is this expected decline in the profit of the group as a result of the known impacts of coronavirus. Admittedly, I think what needs to be debated is how long does it take for normal activity to return, such that the profit generated in the future can get back to that 2019 level. In assessing the valuation, what we're showing in this chart is similar to the Sessile, is the enterprise value. So the shaded green is the market capitalization of Bidcorp, and the key difference between the Sessile example is that net debt within Bidcorp is a relatively small proportion of this group. Net debt to its profit is less than 0.6 times. On the right-hand scale, we've got a measure of profitability, EBITDA, the operating profit before interest, tax, and depreciation. And that red step line is the historic delivered profits that is on the right-hand scale. And we've scaled the chart such that it reflects what we think is a fair value for the group of 12.5 times. What one can observe by virtue of the fact that the shaded area throughout the period 2013 to prior to the fall in March, it traded above that red line, and so in effect was trading on a multiple higher than 12.5 times. And for this reason, we had always considered it to be expensive. However, in the fall, we can see that having delivered 8 billion rand of profit, the market fell 44%. The share price fell 44%, such that its trailing multiple was less than 10 times its last reported EBITDA, We have subsequently seen those downgrades to the coming year's expected profits, but we took the opportunity to build a position in what we believe is a high quality business with low leverage and has shown an ability to grow into the future. Just a reminder, please send through questions as this presentation progresses. Hamilton and I will be addressing the Q&A at the end. We are more than halfway now, and I've got two last stocks to discuss. The next company I'm going to highlight as what we see as an opportunity to generate exceptional returns from these levels is the Mtn Group. Mtn was a company that was a share that we already own in the portfolio. And here we can just see that year to date to the trough in March, Mtn fell 64%. Why the extreme price action? I've tried to summarize in the heading, but this is an economy. Mtn is a Pan-African mobile operator, but is exposed to economies and countries throughout Africa and the Middle East that are oil dependent. So again, the weak oil price threatens those economies. And in particular, the most significant is Mtn Nigeria, where the local currency, the Naira, is facing an almost inevitable devaluation. And then the real challenge, or one of the concerns the market has, is that Mtn does have debt on its balance sheet, and a large portion, or almost 60% of that debt is dollar denominated, that is dependent on these uncertain, volatile cash flows from Africa in order to service that debt. But in light of this price action, again, the question we ask ourselves is, what are we being asked to pay? What's in the price? And are we potentially being given an opportunity where all the bad news, particularly around Mtn Nigeria, is already reflected in the current share price? This is just to set the scene. This is a typical airtime vendor in Lagos, Nigeria. This is a key market for Mtn. It's certainly not it's not as significant as it once was, because it has already seen currency devaluation. This chart represents the sort of our best estimate of what each of the parts of the group are worth. In the case of Nigeria and Ghana, we have used a market value. These shares, these subsidiaries are listed in their respective countries, and therefore we can observe a market price for the asset that we have reflected here on a rand per Mtn Group share price. The first is South Africa, making up sort of 45 rand. Nigeria is a similar contribution to the group's value. Ghana is significantly smaller, and then the other 17 operations or opcos make up 27 rand. In addition, Mtn have embarked on a strategy of trying to monetize what it has identified as non-core assets. These represent a further 9 rand a share. And then lastly, in terms of a value contribution, we have the IHS tower company. Mtn Nigeria effectively sold its tower network to IHS a few years ago in exchange for shares in IHS. This is carried on Mtn's balance sheet at a carrying value of 27 billion rand, which we have reflected here on a rand per share basis. Offsetting these assets is the debt, as I referred to. Mtn does have debt, and a portion of that debt is dollar denominated. That deducts 41 rand a share, leaving you with a potential fair value for Mtn Group of 116 rand. But this is at the prevailing exchange rates. As I've said in the introduction, we believe that there is an inevitable devaluation risk facing these African currencies that are reliant on oil export revenues. And so in the scenarios we've looked at, we've made an assessment of what if the Nigerian currency and the Ghanaian currency were to devalue by 30%, and in an even worse case scenario, what if they were to lose 50% of their value? And then lastly, because IHS represents Nigerian towers, it is a company that is looking to list itself, in which case MTN would be able to extract some value. But what if that asset was deemed to have no value? So we deduct the 14 Rand. So under this scenario, taking account of what we consider to be quite a negative outlook for those currencies, haircutting them by 50%, we still see a share price that or a value of MTN that is worth 71 Rand. In relation to the current share price that is now trading at 49, but in the middle of March fell below 40 Rand, and we used that opportunity to take a larger position. And so, we think that there is, almost 40% upside, even if we, haircut some of the values attached. Another way of looking at MTN is to look at, the other concern the market has is, will we be able to service this debt? This chart represents the cash flow that the group upstreams from its non-South African operations, as well as the cash profit after all capex in South Africa that is available to fund, service debt, but also fund a dividend. The red line represents the dividend that has been paid, and one of the criticisms of MTN over the last 4 years was the fact that it was paying out or maintaining a dividend payout policy despite not having available cash that has led to the increased debt on balance sheet. That there has been subsequent change of management, and management under new leadership have been embarking on the asset realization program referred to. But the main point here is that the purple bars at the bottom represent the interest on the net debt. So this is the finance cost that needs to be serviced. And the primary point I want to draw your attention to is the green, or the cash available, free cash flow available from the South African operations, which in December, or in the financial year 19, accounted for 6 billion Rand. And what we can see is that we don't need cash flow. If we assume that the Nigerian dividend were to, or that there were capital controls and there was no ability to get any cash flow out of these African operations, we're confident that the South African business alone will be sufficient to meet the demands on servicing of the net debt. And lastly, it brings me to the last company I'd like to discuss today, which is Growthpoint. This is a listed property stock. The property sector has come under extreme pressure year to date, and Growthpoint has not been spared either, having lost half its value between beginning of the year and March. What is the market's concern here? Obviously, the lockdown has imposed restrictions on trading activity and normal business. This has led to retailers that occupy some of the shopping malls that Growthpoint owns, demanding that they will pay a reduced rent during the period of lockdown. Any sort of extension to the lockdown is likely to lead to business failures and rising vacancies. There is this high likelihood that we'll see negative rent reversions as we emerge from lockdown. And as with other companies discussed today, Growthpoint has debt. The nature of property REITs is that they fund a large portion of their increased growth in their property portfolio through the use of debt. And Growthpoint has both domestic debt and offshore debt, and that the market is clearly concerned that there is these various factors are likely to see a reduction in the distributions going forward. But what is in the price, as always, is the question we ask. What are we being asked to pay for? And is there not potentially a lot of bad news with Growthpoint having traded as low as 11 Rand last month? This, for those of you who don't have who aren't fortunate enough to live in the mother city, is an image of the V&A waterfront, in particular the district silo. This is an asset that is co-owned by Growthpoint and the PIC. It is a significant asset in Growthpoint's portfolio, but represents just less than 10% of the portfolio. And what I'd like to present today is the idea that you are getting to buy this asset at a significant discount to its last reported carrying value. So here we have the price to net assets, the book value in effect of the property portfolio, so the gross asset value less the debt, and as a ratio of the market capitalization. And what we can see is that for the entire Growthpoint group, you're getting to buy those assets at almost a 50% discount. But what I find more interesting is that Growthpoint has two offshore listed companies, property companies. It has two investments. It owns a stake, just less than 30%, of a London listed Global Worth that owns properties in Romania and Poland. And then in addition, it has a 6% stake in Growthpoint Australia that is also listed. And here in these two charts, we've looked at the distribution yield on the left, and we've looked at the price to net assets on the right. But we have taken those investment assets, offshore investments, at their market value, deducted that from the market cap of Growthpoint, as well as deducting their proportional share of the distributions received, as well as their proportional share of the net assets. And so in the red line, we can observe that the implied distribution yield on the Growthpoint South African portfolio that includes the waterfront in March was expected to yield, or was offering you a potential yield of in excess of 50%. It has subsequently rallied somewhat, but even today that is offering you a very attractive 27%. If we adjust for what we consider to be financial engineered profits that shouldn't be considered ongoing in nature, that distribution yield can be adjusted by 1/4, but it would still leave you earning the potential to earn 20% from that South African property portfolio, which we find incredibly attractive when one considers that the bond yields today, the 10-year bond yield, is now back below 9.5%. On the right-hand side, just looking at the implied price to net assets, there you can see that waterfront asset, in effect, you're getting to buy it at a 60% discount to its net asset value. And so we would argue that a lot of this concern around all those negative factors is largely reflected in the price, and that as and when lockdown were to end, we take comfort from the fact that already we've had some updates to suggest retail activity in the month of April has improved. So in wrapping up today's presentation, I just wanted to leave you or remind you about the long-term track record of the Prudential Equity Fund. We are certainly disappointed in the last 12 months and the underperformance that we have delivered. But over the long run, we remain, we have a robust process, and we are confident that the implementation of that process will continue to deliver superior results for you as unit holders. The fund has maintained top quartile performance on a rolling 3-year basis. It has beaten the peer group as shown in the solid black line. The fund is in red, and the FTSE All Share SWIX index is in the blue line. all of the funds that make up the general equity unit trust category are shown in the grey background lines. I thank you again for taking the time to listen to this presentation today. I'm going to hand back now to Hamilton, and we will attempt to answer any questions that you have sent through. Thank you.
Thanks for that, Chris. I see that we do have a few questions from the audience, so I'm going to read them out. Chris, the first one, what are some of the key concerns around COVID-19, and what stocks or sectors have weathered the storm better than others?
Thanks, Amy. Yeah, so it is fair to say that it's not, as alluded to in the presentation, it's not the number of people that ultimately lose their life that is of concern here. It's actually the consequences of, continued extension of a lockdown or a putting the economy on hold. That's both relevant to South Africa, but equally concerning for the rest of the world. In terms of companies that have weathered it better than others, it's clear that any business that was deemed to be an essential service has continued to trade, and therefore has not been impacted to the same extent. So our food retailers, the likes of Spar, Shoprite, the chemists, the pharmacies, have all been allowed to continue trading, and so we can observe even in their share prices that they've proven to be more defensive. In terms of other stocks on the JSE that have fared very well, the gold price, it's a safe haven. It has remained fairly elevated, and then when one overlays the weaker currency, we can observe that gold stocks have probably been the best performing. And then, the single largest company on the JSE remains the sort of Naspers Group, where one can either take exposure through Process or Naspers. Yesterday, we had Tencent report their first quarter results. This is a listed company in Hong Kong that, from which Naspers derived the bulk of their value. This business has been incredibly resilient. So even though this virus originated in China, they were locked down earlier than other countries. The nature of the Tencent business, which is largely an online gaming franchise, has seen a very large increase in time spent online, and they delivered some exceptional results yesterday. So the Naspers Group, has a stake in Tencent, and its share price has performed very well throughout this period.
So just in the past 2 months, Chris, what are the biggest changes that you've made in the portfolio?
Okay, so we have been certainly more active than would normally be the case. We've probably, bought and sold around just over 15% of the portfolio over the last 2 months. At a stock level, the biggest changes made were in terms of purchases. Was to buy Remgro, the Bidcorp example that I talked to in the presentation. We've included Growthpoint as well as Impala Platinum and Mtn. In order to fund those additions to the portfolio, we have sold some of those shares or companies that have proven to be more resilient, and so try to exploit a valuation differential. So the stocks that have been sold is, previously British American Tobacco was our single largest overweight. That active position has been reduced, so we still have exposure, but we've sold a portion of our stake. In order to fund the Impala Platinum, we had previously held the Zambezi Pref instrument that relates to the Northern BE transaction, and this was sold in order to take direct exposure to equity within the platinum sector. And then the last two stocks that have been sold out of the portfolio was Pick n Pay, for precisely the reason I explained in the first question, is it has continued to trade as normal. Its share price didn't fall to the same extent as the other opportunities that were presented to us, and therefore in a recovery it was difficult to see where the upside would be. Yes, it's been defensive, but it's basically provided funding for what we see as better opportunities to generate prospective returns. And lastly, the 91 asset management business that was unbundled to us from Investec was also sold in order to fund some of these alternative ideas.
Chris, just your terms of the offshore holding, are you sort of bringing more money back?
Yeah, thanks, Hamid. So, the previous answers related to the changes made at a stock level. The single biggest change to the Prudential equity portfolio over the last 2 months was, in fact, a sale of some of our offshore allocation in order to create inflow into the SA portion. We sold just over 4% of the fund that was previously invested in the Prudential Global Equity Fund, as well as the Prudential Africa Fund. So the fund at its peak had about 25% offshore. As it stands today, that is now just less than 21%. And that was specifically because of that valuation differential that we could observe between the rest of the world and the South African equities. On that price to book series, you will have seen that the world index has only really pulled back to its sort of median multiple, whereas the SA equities, on various measures of valuation, are trading well below median, more than a standard deviation into cheap territory, and are as cheap as they've ever been, and comparable to sort of the levels seen in the global financial crisis.
So, Chris, a lot of our competitors are taking more offshore exposure due to the instability in South Africa. So, are you basing your positions on valuations? There is a concern how South Africa will survive, and if earnings don't come through, how will your positioning in South Africa stocks reflect in our performance?
Yeah, so I've tried to reiterate, that we are valuation based in our thinking, and that we are trying to, focus on the long-term value opportunity. That doesn't mean that we're dismissive of the short term. We have, like the example of Bidcorp, we have ensured that the businesses we're investing in are cash generative, do have strong enough balance sheets and liquidity available to ensure that they emerge from this period of lockdown. I have to say that that the future is uncertain, and therefore we don't know exactly when life returns to normal, and that as to when trading resumes and behavior goes back to life as it was is something of an unknown. But we do think that the valuation signal is strong enough to want us to take that risk, or that we are being offered an incentive to take more active positions in some of these domestic focused stocks. But one needs to be careful about, obviously, ensuring that the business can survive or has sufficient, is able to service its debt. Thanks.
Yeah, Chris, in your presentation, you didn't highlight anything or talk about the banking sector. And we do know that you have a high weight in banks, and given likely increase in impairments in the banking sector, if you look at they'll obviously be under pressure. Just your thoughts on that. They're likely to suffer.
Correct. The overall portfolio's exposure to banks is around 11% at a total portfolio level, and in terms of an active, we are overweight. We're roughly 3% overweight relative to the average peer group allocation. That active position is heavily skewed towards a sort of a 2% overweight Investec, and 1% overweight in the remaining, let's call it domestic-focused banks. The analysis we've done in looking at, for example, Standard Bank, which is one of the preferred exposures in the portfolio, is the South African banks are significantly better capitalized today than they were in previous crises, and this is largely because of the they are Basel compliant, and those regulations were introduced post what played out in the global financial crisis of 2008, 2009. These banks are very profitable. They cash generative. So you need to first incur losses and wipe out your earnings before you start eating into the capital that they hold. And then in addition, they are well provided. So we're under no misillusion that there will be a rise in bad debts. There will be businesses that fail. We've already seen news of, for example, AfriSam having emerged from business rescue with a debt for equity swap and is now in the hands of the banks. We know that Comair and SAA are in business rescue, and so the banks will have to take some sort of a hit in terms of losses. But we do, our sense is that they are very well capitalized and have sufficient provisions to be able to weather the storm.
Thank you, Chris. You spoke about Growthpoint earlier. You had a few slides on Growthpoint. So there's a question on Growthpoint. What will be the impact of Edcon going into business rescue on Growthpoint as a stock? And they are a big tenant with a big question mark.
Yeah, so Edcon is certainly a large retailer in the South African market, and most of the South African property REITs do have some exposure. In the case of Growthpoint, it accounts for roughly 6.5% of their gross lettable area is tenanted by Edcon. But what one needs to consider is that these large anchor tenants generally pay below average rentals for that space. So when we actually look at Edcon in terms of as a percentage contribution to Growthpoint's distribution income, it's less than 1.5%. So it has a larger share of the space than it does in terms of contribution to profit. So losing Edcon will have a negative impact. But in the case of Growthpoint, it's the geographic diversification of the portfolio. It's the fact that more than roughly 40% of the net asset value is in fact is offshore, and therefore we think it can survive. One also needs to give consideration to the fact that space is not likely to remain vacant forever, and that we had an example from Resilient where they were able to relet some of the space that has already been vacated by Edcon at in fact higher average rental rates than what was being received previously from the Edcon Group. So it is negative. It's a headwind for the sector, but our view is that it's not insurmountable.
So I've got one more, and we've got a few minutes left. Do you believe Prosus and to some degree Naspers are overpriced at current valuations, or do they have more legs over the next 3 to 5 years?
We still remain favorably disposed to the Naspers Group, and we are overweight in terms of our holding relative to the average that we can see that is held by other funds in South Africa. The reason we continue to like Naspers as an investment is that whether you invested in Prosus, which trades at a discount to its theoretical value of its stake in Tencent, or you take the additional layer of discount that Naspers trades relative to Prosus, what we like is that you're basically getting a discounted exposure to an underlying asset that has shown an ability to continue to compound growth in intrinsic value. And this is before one gives any credit or attaches any value to the other assets that Naspers themselves have invested in terms of food delivery, payments, and online classifieds. So the discount at which Naspers today trades at relative to Tencent, the value of its stake in Tencent is just less than 40%. And then if one takes account of the potential value in their other assets, it's trading at a 50% discount to the total portfolio. And we think that discount is just too wide, and therefore we continue to want to own it. Tencent does, on the face of it, look expensive, but when delivering year-on-year underlying growth in earnings as they did yesterday of 27%, that we still think that you can justify the multiple that you're being asked to pay for that business.
So the one sector we haven't really touched on, Chris, is the mining sector. Prior to COVID or the pandemic, did very well. The mining sector, post the sort of right at the bottom, bounced very well too. Just your thoughts on the mining sector?
Yeah, so the most obvious benefit that our mining companies are seeing today is that of a weaker exchange rate. So reality is they are in most cases incurring rand-based costs, extracting a commodity that is exported to the rest of the world and for which they receive a dollar commodity price. So we do have a preference at the moment for diversified exposure, and we have had a preference up until or this year for platinum over gold. The lack of gold in the portfolio has been a detractor, but we do own both Impala and Northern Platinum, with the largest overweights being Anglo American and Exaro. So the unknown or the concept or the headwind or impact of COVID remains the fact that the South African mines are unable to be at the moment are restricted from operating at full capacity. They're currently only operating at 50% of the capacity, and so it's like with some of the other previous questions. The unknown for us is at what point do we get back to being able to operate at normal levels? But we do think that at the prevailing commodity prices, which have remained fairly robust, and taking account of a weak exchange rate, underlying earnings have upside risk rather than downside risk in terms of relative to consensus expectations.
So, Chris, most market commentators are referring to the current COVID situation as unprecedented. I think that's a bit obvious. But are there any parallels in your career that you can draw on for guidance during these times in terms of picking winners and certainly avoiding the losers?
As a seasoned equity investor, I've been in this role 20 years. I started in 2000. 15 of those years have been here at Prudential. So we have seen ups and downs. It's the nature of the game. There are any number of previous crises that South African investors have had to live through. I can mention some, such as Nenegate, the global financial crisis. Starting at the beginning of my career was sort of the tail end of the IT bubble, so almost the opposite of where we find ourselves today. But I do think one can draw on the experiences. The example I gave of the Sessile bond reminds us of Prudential of us in the Prudential Equity Fund having bought the old mutual bonds in the height of the GFC. There are a number of examples where our colleagues in London at M&G often say that buying cheap stocks or out of favor companies that the market has taken a dislike to is actually often quite difficult. It's an uncomfortable thing to do, to buy these stocks, but I think past experience helps in that we know that it's we will the market will recover, or the world will at some point return to normal, and that it's about assessing the odds that are being offered to you to take on the trade.
So we have run out of time, but I want you to answer just one question, and that is, Chris, in closing, why should investors entrust their savings with Prudential and certainly your equity fund?
Thanks, Amy. So why Prudential? I need to say up front that I sort of ended my presentation by showing the past track record of the fund, and it's there is a proud tradition or a record at Prudential in terms of delivering our performance across a variety of products that we manage. Past performance is certainly no guarantee of future performance, but what I think that track record speaks to is the robustness of the process and the philosophy that we have embedded in our process at Prudential. And I can assure you that that's unchanged, and it's been the same for the 15 years that I've been here. Secondly, it is a very much a team-based approach. There is a depth of talent that contributes to the ideas that are, that I happen to, discuss with you today. And I think that's, it's that consistency, it's that process, and it's that team-based approach that I think, we hang our hat on, and that, we should hopefully have given you some comfort to invest with Prudential. And then I think what I've tried to hopefully demonstrate in the presentation today, and sometimes I get criticized for some of my slides and being a little bit too complicated, but we are detailed in the analyses we do. We're bottom-up investors, and we do certainly try and dig into the financials and make sure that we're not taking we're trying to prevent the sort of unintended consequences of the positions we take. So hopefully that, as to why the Prudential Equity Fund, we do think that this fund has a decent track record, is prepared to take active risk, and gives investors both exposure to cheap South African equities, as well as having a portion of its allocation offshore.
Thanks, Chris. Well, I do expect the team to deliver, because I personally switched some of my own fortune into the fund. So there are a host of questions. We haven't been able to address all of them, but we will certainly endeavour to respond to each one by email or online. In terms of CPD points, just a reminder that they will be available. We will let you know as soon as we get a response from the FPI, and you'll also get a link with a survey to the presentation itself. So thanks again for your valuable time. Enjoy your day and keep safe. Thank you very much.
Thanks, everyone.
And thanks, Chris.
Thanks, Amy.